Welcome to DebtCircle Key Roundups. I am Vijendra.
And I am Leela.
We've got some important updates in the world of finance and debt instruments. We'll start with L&T Finance, which has recently allotted 380 crore rupees in non-convertible debentures with an attractive coupon rate of 8.20%, a significant move for investors looking for fixed income options. L&T Finance allotted 380 unsecured non-convertible debentures totaling 380 crore rupees with a tenor of 10 years and 1 month, maturing on July 1st, 2036, at that 8.20% coupon rate.
This issuance strengthens their long-term debt profile. The fixed coupon of 8.20% per annum is attractive given current market rates, and listing on the National Stock Exchange's negotiated trade reporting platform ensures liquidity. Investors should weigh the subordinated status against the stable interest and clear repayment schedule. The regulatory compliance with Securities and Exchange Board of India norms adds confidence in transparency and governance.
Interest payments will be made annually every July, starting July 1st, 2027, with an additional 2% penalty interest if payments are delayed. The debentures are subordinated and unsecured, highlighting their risk-return position. Here's another significant update. Banks saw a sharp rise in foreign currency non-resident bank deposits, reaching nearly $7 billion in June alone. This surge follows RBI clarifications and incentives, with projections of $50 billion in inflows within about 45 days.
That's significant, especially as non-resident Indians and family offices from Dubai and Singapore are leading the inflows. The clearer operational guidelines and loan facilities against these deposits are boosting confidence and demand. Banks like Yes Bank and AU Small Finance Bank have increased FCNRB deposit rates to attract funds, with Equitas Small Finance Bank offering the highest at 7.13% per annum.
Plus, dedicated deposit desks have cut onboarding times to 5 to 7 days, ensuring compliance and faster processing. Alongside FCNRB, government bond inflows via the fully accessible route topped $2.5 billion by June, showing strong investor interest. Let's look at another key development. FinCurve Financial Services paid interest totaling 41.66 lakh rupees on 2 NCD tranches of 50 crore rupees each on June 30th, 2026, a day before the July 1st deadline.
That early payment shows strong compliance with Securities and Exchange Board of India regulations and reassures investors about the company's debt servicing reliability. The first tranche, with an issue size of 30 crore rupees, paid 24.96 lakh rupees in interest. The second, 20 crore rupees, paid 16.69 lakh rupees. Maintaining monthly payments without delay or redemption keeps investor confidence steady and signals stable financial health in the debt market.
Let's look at another key development. Gold prices in India jumped sharply on July 2nd, 2026. 24-karat gold rose by 3,770 rupees per 10 grams, reaching 1,44,500 rupees. This surge followed easing inflation signals from the US Federal Reserve.
That easing reduced expectations for US rate hikes in 2026, boosting precious metals. Despite local volatility on the multi-commodity exchange, strong buying interest drove prices up, reflecting renewed investor confidence globally. Let's move on to our next article. Himatsinka Sage raised 15 crore rupees through 300 Series D non-convertible debentures, each valued at 5 lakh rupees. These are unlisted, unrated, and secured by manufacturing assets, offering investors collateral and reducing credit risk.
The 11.50% annual coupon paid quarterly is relatively high, reflecting risk. The 42-month tenure with principal repayments at 30, 36, and 42 months helps manage cash flow, but investors must watch the company's liquidity closely. There's a 2% penalty interest if payments delay beyond 3 months, so consistent cash flow is critical to avoid extra costs and meet quarterly interest and staggered principal repayments.
Given the unrated status and secured nature, this issuance balances risk and return. Market conditions favor such instruments for yield, but monitoring operational performance over the next 3 years is essential for investor confidence. Now, let's discuss another important development. The Indian rupee fell by 19 paise to 94.75 against the US dollar on July 1, 2026, mainly due to the US dollar's strength and RBI strategy of rebuilding foreign exchange reserves, which limits rupee gains.
This depreciation reflects broader market trends, with the dollar index holding above 101, driven by the US Federal Reserve's cautious stance, maintaining pressure on the rupee amid ongoing geopolitical uncertainties. Additionally, geopolitical risks, especially the unresolved US-Iran peace talks, raised risk premiums, Brent crude oil rose to $73.23 per barrel, influenced by easing oil flow tensions, affecting market sentiment.
Domestic markets showed resilience with the Sensex up 182 points and foreign institutional investors selling equities worth 2,556 crore rupees, highlighting cautious investor sentiment amid fiscal and global concerns. Moving to our next story, CSL Finance's assets under management grew by 15% year-on-year, reaching 1,510 crore rupees in the first quarter of fiscal year 2027. They disbursed loans worth 320 crore rupees and collected 290 crore rupees, showing steady operations.
That growth reflects healthy demand, especially with a capital adequacy ratio at 44%, indicating strong financial stability. The liquidity surplus of 175 crore rupees and undrawn sanctions also support ongoing lending capacity. Additionally, they raised 60 crore rupees through non-convertible debentures, part of a planned 150 crore rupee issuance in multiple tranches, with the portfolio mix shifting slightly to 70% wholesale and 30% small and medium enterprise lending.
Operating across 37 main and 25 spoke branches with 455 employees, CSL Finance maintains a balanced lending focus, positioning themselves well for sustainable growth in fiscal year 2027. Let's look at another key development. CRISIL assigned a B+ rating with a stable outlook to Jagatjeet Industries loans amounting to 47 crore rupees. The rating reflects their operational experience but flags high financial risk due to elevated leverage.
The market context shows that despite a revenue drop from 491 crore rupees to 253 crore rupees in fiscal year 26, Jagatjeet returned to profitability, improving margins to 3.90%. However, their adjusted debt to net worth ratio remains high at 5.70 times, and the interest coverage ratio is negative at -1.31, indicating ongoing liquidity and debt servicing challenges.
Going forward, margin recovery to 3 to 4% is expected, but regulatory pressures and high gearing will keep investors cautious about Jagatjeet's credit health and cash flow stability. Here's another significant update. South Indian Bank's gross advances grew by 17.01% year-on-year to 1,04,366 crore rupees in the first quarter of fiscal year 27, surpassing the 1 lakh crore mark. Deposits also rose 11.39% to 1,25,786 crore rupees, with a CASA ratio improvement to 32.99%.
This strong credit growth outpacing deposits indicates robust loan demand, but may tighten the credit to deposit ratio, possibly increasing funding costs. However, the rising CASA deposits, up nearly 15%, help maintain a stable and low-cost liability base, which is crucial for sustaining net interest margins amid competitive markets. Despite a technical write-off of 1,048 crore rupees in the previous quarter, the adjusted advance growth remains a healthy 18% year-on-year.
This shift towards higher yielding assets combined with steady liability management positions the bank well for improved profitability if asset quality holds steady. The bank's aggressive credit growth and improving deposit franchise reflect a transition towards a pan-India mid-sized lender, and the record net profit of 1,455 crore rupees last year supports its strong growth momentum. Let's look at another key development. The National Company Law Appellate Tribunal in New Delhi revived IL&FS's plea on 6 transactions worth 1,080 crore rupees, alleged circuitous lending deals meant to bypass Reserve Bank of India rules, overturning the earlier dismissal by the Mumbai National Company Law Tribunal.
This signals stricter scrutiny of complex financial transactions in the infrastructure sector. The market can expect heightened regulatory attention on group exposure limits and fund routing, especially involving major players like IL&FS and SREI Infrastructure Finance Limited. The NCLAT emphasized its broad powers under Sections 241 and 242 of the Companies Act, rejecting narrow interpretations limiting intervention in fraudulent deals, and called for a fresh judicial review of the alleged sham transactions flagged by RBI and other agencies.
This sets a precedent reinforcing tribunal authority against fraudulent financial structuring. It may encourage more rigorous investigation and potentially impact other cases where regulatory circumvention is suspected, affecting market confidence in financial disclosures. Let's look at another key development. GIFT City will showcase its status as India's premier international financial gateway at the vibrant Gujarat Summit on June 30th, highlighting banking assets of $111 billion and a fund management ecosystem with over 217 entities managing $36 billion.
This growth signals strong confidence from global investors, positioning GIFT City as a key platform for cross-border finance and fund management, which could accelerate India's integration with global markets. Additionally, GIFT City hosts over 1,500 entities with 27,000 professionals and is emerging as a hub for aircraft and ship leasing, with 35 aircraft lessors and 36 ship lessors managing hundreds of assets.
The presence of global and regional corporate treasury centers lending over $5,610 million US further strengthens its role in treasury management and cross-border financing, boosting India's global financial connectivity. Let's move on to our next article. Bloomberg's Index Committee will decide in mid-July on including Indian government bonds in its Global Aggregate Index, a move driving the bond yield down by 26 basis points to 6.74% on the 10-year paper.
That inclusion would attract massive foreign inflows given the index tracks over 70 trillion US dollars. The Reserve Bank of India's recent addition of 15, 20 and 30-year bonds to the fully accessible route also boosts investor confidence. Foreign portfolio investors put in a record 55,518 crore rupees in June, anticipating index inclusion, and Goldman Sachs projects 15 billion US dollars in passive inflows during the phase-in after the announcement, expected by mid-2026.
Plus, Indian government bonds are already in 3 major emerging market indexes, strengthening India's fixed income appeal. Regulatory changes encouraging Tata Sons public listing support Shapoorji Pallonji's 25,500 crore rupee bond issue, showing growing confidence in Indian credit markets. The Shapoorji Pallonji Group is raising 25,500 crore rupees through zero-coupon bonds backed by its 18.37% stake in Tata Sons, with repayment hinging on Tata Sons announcing an IPO or a settlement within 18 months, and half the amount due in 2 years under strict deleveraging covenants.
This is significant given recent Reserve Bank of India regulations classifying Tata Sons as an upper-layer non-banking financial company with mandatory listing requirements. Tata Sons' assets exceed 1,75,000 crore rupees, making an IPO highly likely and supporting SP Group's ability to monetize its stake and repay the bonds. The bonds carry an 18.95% coupon rate, reflecting their high-risk profile, and are unrated zero-coupon non-convertible debentures issued via equity as an investment, with the pledged Tata Sons shares providing collateral to enhance investor security amid refinancing challenges.
Market volatility delayed the issue from April to July, but regulatory clarity and positive signals from Tata Sons leadership improve investor confidence. The deleveraging clause further protects investors by requiring repayment of at least 13,500 crore rupees within 2 years, reducing refinancing risk. That wraps up today's roundup. Thanks for tuning into the DebtCircle podcast.